Hello everyone, welcome to InvestorThread.com. I'm your host Josh Inamoto as usual. So I want to get into an interesting idea. As you know, the box office, the Cineplex industry, has been going through an ebb and flow. Has been an interesting time. Has been a profitable time in certain cycles, and then also challenging. And in 2024, it looks like Cinemark, specifically, which is ticker symbol CNK, has started to recover with their recovery initiative. The box office itself has the sentiment has improved. So supposedly with the normalization of society, plus with the performance of big Hollywood hits, that has improved the business of Cinemark. And so, of course, CNK stock has been one of the top performers. I think it's almost, let me check here, it's just about doubled in value on a year-to-date basis. So this is an impressive situation. The issue that I see right now, though, is that in the technical charts, I'm looking at it right now on TradingView.com. Between, I would say, between Monday of August 26th, Tuesday, August 27th, and September 12th, right around there, and then today, if you look at those time frames, it appears that there is a bearish head and shoulders pattern that is being charted. Now, how much weight do you put on that assessment? Some might not put that much assessment, that much weight on that particular analysis, in part because of the strong revenue performance of Cinemark, and the security itself has been moving higher. However, actually, I also wanted to point out that in terms of the options market, the options flow screener from bar chart shows that net trade sentiment is at $132,300, favoring the bulls. So that is an encouraging framework if you're optimistic about Cinemark. Here is the thing, though. And now what's interesting about the options flow is that most of the transactions, in fact, all of the transactions, are sold puts or underwritten put options. And so the major speculators, the major investors, are underwriting the risk that CNK will not fall down. That is a credit-based strategy, and that's not quite the same as a debit-based strategy where you're paying a premium in the speculation that CNK will directly move higher. Here, where the major investors are betting that it will not move lower. So interpretation-wise, we're looking at sentiment that is moderately bullish at best and essentially neutral. Now, most of the sold puts, at least in terms of dollar volume, you're looking at the $30 strike price with an expiration of January 17th. So that's a few months away from now. So it's more of like a medium tier time target. So they're anticipating that essentially CNK will be trading around where it is right now till January of next year. That seems reasonable. That seems very reasonable, but at the same time, it's not the most directly bullish or decisively bullish thesis here. Okay, now my concern, I have to go back to the technical chart. I'm seeing, based on tradingview.com, the data does appear to be charting a bearish head and shoulders pattern, even though the market itself, we're looking at options data and the options flow specifically, it seems that the major investors are bullish. There could be a case here where the market could be softening a little bit in the near term. Now, if you want to be aggressive, you may want to consider a vertical option spread, specifically a bear call spread. Now, bear call spread involves selling call options, which is it's essentially a bearish strategy. But at the same time, we're going to cap our risk by buying a call at a higher strike price on the same expiration date, so that we cap our liability in case the trade goes against us, in this case, if CNK moves higher. Now, I'm specifically looking at the nearest expiration date of October 18th. So this is not, I'm not looking at CNK as a bearish long-term opportunity. I am not saying to short the security itself. And I'm disclosing up front that this is an aggressive idea because the other major indicators, such as options flow and the fundamentals, point to a recovery, point to a bullish recovery. So we are admittedly going against the tide, and not only going against the tide, but going against the tide of the major investors, which is always going to be risky. However, the reason why I'm presenting this idea is that I don't disagree with the major investors in terms of CNK over the middle to longer term, medium to longer term. It could stay stable and then it could eventually move higher. I don't disagree with that concept, with that analysis. But as I said, with that, potentially with the head and shoulders pattern being charted in the near term, there could be an opportunity to extract profits from the downside. And so the bear call spread looks very compelling, in my opinion. And there's also, what's interesting is that if you do decide to go with a bear call spread, there is a pricing inefficiency, at least as of Monday's close. So I'm looking again at the expiration chain expiring October 18th. And the one that I'm interested in is the idea of selling the $28 call and then buying the $30 call. Now, if you do that based on the bid and ask spread at the time, the maximum reward that we can extract from this setup is 50 cents per contract. 50 cents is the credit or income that we receive up front, and the maximum that we can lose is $1.50 or $150 when you apply the options multiplier of 100 shares. So $50 reward, risking 150. The risk to reward ratio, it comes out to 3-to-1, meaning that for every $1 of income that we receive, $3 is at risk. Now, bar chart has the probability of success at 61.6%, so almost 62%. That means that there is a 62% chance that we will be at least somewhat profitable with this trade. Now, the pricing inefficiency comes with the next best bull call spread, which is to sell the $28 call and buy the $29 call. Here, the maximum profit is 25 cents per contract, and the maximum loss is 75 cents per contract. If you do the quick math, the risk to reward ratio is exactly the same, 3-to-1. And the probability of making a profit in this trade is actually lower, 57.3%. And what's also interesting is that in the first spread that I mentioned, the break-even price is $28.50. In this spread that I'm talking about right now, the break-even is $28.25. And so with a bear call spread, we're trying to protect the higher price, because the higher price is, if the stock goes higher in a bear call spread, that is unfavorable to us. So with the so essentially we have a pricing inefficiency, because with the first trade that I mentioned, you have the same risk reward ratio of 3-to-1, but you have a higher margin of safety, slightly higher at 28.50 compared to 28.25. And yet, even though you have a higher margin of safety, you have a greater chance of profitability. So, greater chance of profitability with a greater margin of safety, and the risk reward ratio is exactly the same at 3-to-1. Now, nominally, you do have to put up a little bit more risk, 150 instead of 75 cents, but still, the ratio, when it comes down to it, is still 3-to-1. So identical ratios, but better profit probability and higher margin of safety in terms of the break-even price. To me, that seems like a no-brainer. If you were interested, and I'm not saying one way or the other, but if you were interested in a near-term bearish idea for Cinemark, there is a bear call spread, the nearest one, the October 18th expiration date. There is a pricing inefficiency. Now, I'm not sure if that pricing inefficiency will be eliminated on Tuesday, but who knows? It's not the most high volume options market. When you're talking about Cinemark, I think AMC would have a much higher volume. But I wanted to put that on your radar. I'm probably going to talk about it in tomorrow's publication for bar chart. If you happen to follow my column on unusual options activity, I'm probably going to look at Cinemark simply because of that pricing inefficiency. You can get a lot of the same reward ratio, but for and at a higher probability of success. I mean, it's the best of all worlds when you're looking at that trade. Now, of course, there is no guarantee, absolutely no guarantee that this trade will materialize in the way that I think it will. But again, if you happen to share the near-term bearish thesis for Cinemark, this is a trade, an options trade you may want to consider. So for more ideas, please check out my website, investorthread.com. Thank you.